The pursuit of consistent profitability within the global financial markets is frequently characterized as a technical endeavor requiring the optimization of complex algorithms. Yet an exhaustive review of market mastery reveals that the primary differentiator between professional success and retail failure is the structural discipline and psychological consistency with which a trader executes a predetermined plan. Trading success is often misunderstood by participants who believe that profitability originates from finding a perfect strategy. In reality, long-term consistency is built upon a foundation of structure, rigorous risk management, and the neutralization of emotional reactivity, transforming speculation from an emotional game of chance into a structured business operation that rewards patience over adrenaline. This transformation is notoriously difficult because human physiology is fundamentally ill-equipped for the stresses of trading, as market uncertainty triggers powerful hormonal responses like spikes in cortisol, which can rise by as much as 68% over volatile periods, preparing the body for fight or flight, while suppressing the cognitive systems required for rational decision-making. This biological shift leads to a state of irrational pessimism and a dramatic drop in risk willingness, often causing traders to avoid taking necessary risks exactly when a crashing market offers the greatest opportunities. Legendary traders like Ray Dalio, Paul Tudor Jones, and Stanley Druckenmiller acknowledge this challenge, crediting their success to strict daily routines and mental control practices like meditation to maintain a firefighter's calm amidst market chaos. To counteract these biological tides, discipline must be viewed as a mathematical necessity derived from the law of large numbers, which guarantees that while the outcome of an individual trade is random, the performance of a large sample will converge to a predictable edge if the system is applied consistently. Without the discipline to follow a plan through statistically inevitable losing periods, a trader never reaches the sample size necessary for profitability, often falling victim to the gambler's fallacy, the belief that after a string of losses, a win is somehow due, or the hot hand fallacy, which falsely assumes a winning streak will continue indefinitely. This is further exacerbated by cognitive biases like loss aversion, where the pain of a loss is felt twice as intensely as the joy of a gain, leading traders to hold losing positions too long in a desperate attempt to avoid realizing failure, ultimately resulting in the disposition effect, where they sell winners too early to capture a sure profit while letting losers drain their accounts. Overcoming these inherent flaws requires a robust trading plan that moves risk management from a recommendation to a non-negotiable foundation, typically limiting risk per trade to 1–2% of total capital to ensure that even a series of losses does not lead to a devastating drawdown. Such a plan must include objective entry and exit criteria that eliminate in-the-moment decisions, which are almost always driven by emotion rather than data, allowing the trader to act as a detached executor of a proven process. This involves a profound shift from an outcome-oriented mindset focused on daily profit and loss to a process-oriented mindset where success is defined solely by the flawless execution of the plan, regardless of the financial result of any specific trade. Historical proof of this approach is found in the Turtle Traders experiment, where Richard Dennis proved that novices could earn millions by following mechanical rules for entry and risk control, provided they possessed the mental strength to pull the trigger on every signal. Dennis taught his turtles to use indicators like the average true range, ATR, to measure volatility and adjust position sizing accordingly, ensuring that risk remained stable even in volatile markets. To achieve this level of mastery, traders must internalize the 5 fundamental truths of trading. Anything can happen. You don't need to know what happens next to make money. Wins and losses are randomly distributed for any edge. An edge is just a higher probability of one thing happening over another, and every moment in the market is unique. In the modern era, This discipline is augmented by technological auditing tools like Edgewonk's tilt meter, which quantifies emotional instability and tracks the specific dollar cost of every rule break, helping traders identify patterns like revenge trading or hesitation. Journals now allow traders to track execution timeframes and chart patterns to see where their decision-making is most effective, turning psychology into a data problem that can be solved through systematic review. Accountability is critical, and institutional standards at prop firms reward those who prioritize consistent behavior over reckless risk-taking, reinforcing that the ability to manage emotional triggers, fear, greed, or boredom, is what separates the professional from the hobbyist. Ultimately, the trader who succeeds is the one who treats the market as a professional business, adhering to a repeatable process even when the environment is at its most volatile, recognizing that while they have no control over the market, they have absolute control over their own actions. By focusing on long-term participation rather than trying to capture every short-term movement, disciplined investors allow their measurable edge to compound over time, transforming the chaotic noise of the financial markets into the predictable architecture of trading excellence. Now that you understand the biological and mathematical forces at play, the question is, how will you bridge the gap between theory and execution? Success does not come from discovering a better indicator. It comes from building a better version of yourself. Start today by implementing a digital audit of your behavior, moving beyond the amateur habit of simply logging numbers to documenting the emotional states behind every entry and exit. Whether you use Edgewonk's tilt meter to quantify your emotional stability or Journal Plus to link your mood directly to your P&L, you must transform your psychological patterns into actionable data. Commit to a 100-trade challenge where your only goal is the flawless execution of your written plan, regardless of the financial outcome of any single position. Document every emotional trigger, the fear that whispers to sell winners early and the greed that begs to hold on to losers, and use these insights to build mental resilience. Remember the 5 fundamental truths. Anything can happen, and you do not need to know what happens next to make money. Stop gambling on your gut feelings and start operating like a casino by trusting the law of large numbers to manifest your edge over time. Your path to professional mastery is paved with discipline, one correctly executed trade at a time. The market is waiting. It is time to stop reacting and start performing. Treat your trading like the professional business it deserves to be.